how do I pay myself for my business? Jeff, do you want to whack this?
Well, I mean, there's two kinds of businesses we're talking about. Either businesses that we report on our 1040, like your sole proprietors and rental businesses. Then you have your pass-through businesses, which is kind of the same thing, where the income's just passing through you. And then we have your corporations.
Mm-hmm.
Let's say you have a partnership or an S corporation. You're being taxed on your share of the income, whether you pay yourself out or not.
So I'm going to just draw some of these up. So you have a C-Corp, an S-Corp, a partnership, and a sole proprietor. Am I missing one?
Yeah, rentals, but we can throw that in with sole proprietors.
Yeah, but these are like your big headings. And this could be an LLC taxed as any of those. LLCs do not exist as far as the IRS is concerned. They tell you to select. Sole proprietor, you and your business are the same. Because of that, you get the crud audited out of you, about 700% more likely than your Escort counterpart, and the IRS wins 94% of the time. So you're pretty much toast because you and the business are the same. So they like to say everything's a personal expense, et cetera. But if you want to get your money out, you can't pay yourself a salary. It's just you and the business are the same, so it's the same bucket. You could use the same account.
Right.
Same here with your partnership. There's a few exceptions, which is if you have a limited partnership, if there's a general part, if there's a manager of a LLC taxed as a partnership, but it's the same bucket. In other words, whether you leave it in there or take it out is immaterial. There's no tax ramification. Then you get to your corporations, and you get a huge benefit because you give yourself W-2 wages, and then there's distributions from that S-Corp. That distribution out of the S-Corp is a bucket that you can take money out of and put money in all the time. So you can always take the money out of an S-Corp as well because it flows down to you. All of these, I'm going to circle them. All of these are what are considered pass-through, meaning the taxes pass through to you. This guy over here, that C-Corp, that one is a little different because it is a separate taxpayer. And it's taxed, by the way, at 21%. That's on its profits. And then if it pays you out anything else, you're going to be looking at a dividend. So that's how you pay yourself if you're trying to get paid for your work or you're taking out profit. If you're reimbursing yourself for an expense, you literally just write yourself a check. You submit a request to the company and say, hey, I have some expenses that I've incurred out here, and the company just pays it to you. So you're standing out here saying, hey, pay me, and it just pays you. If it's compensation, hey, I'm going to pay you for your time, it's W-2. If it's the profits, then it's a dividend out of a C-Corp. All these others, you're pretty easily able to take a bunch of money out anytime you want. Makes it pretty simple.
The other thing we often have in the C-Corps is there's a shareholder loan on the books.
Yeah, so let's say the company needs money to get started and you loan, then it can reimburse you. And it says, I heard you say you pay 20% tax on profit. So, Chad, on a C-Corp, it pays 21% flat tax on all of its profit. So if a C-Corp makes, let's say it's $100,000. We'll use the example. If Jeff made the $100,000 on top of everything else he makes, let's say he's in the top bracket, he's going to be taxed federally at 37%.
Right.
If a C-Corp makes that same $100,000, it's going to be taxed at 21%. If the C-Corp turns around and pays Jeff whatever's left, so let's just say it's $100,000, it's at 21%, so there'll be $79,000. 100,000 minus 21 is 79,000. That 79, and it hands it to Jeff and says, here's a distribution of all of our profit. Jeff has to recognize that in our cases, these are domestic U.S. entities, as long-term capital gains. Sounds weird, but the dividend rate is the long-term capital gains rate. So again, assuming that Jeff is in the highest tax bracket, he will pay 20% on that money. And since he's in the highest tax bracket, he's probably paying the net investment income tax on that too, right?
Another 3.9%.
Another, yeah, 3.8, 3.9. What is it now? Is it 3.9?
I think it's.
I tend to blabble on that stuff. More than 3. So, so at the end of the day, when you start to add those things up, you're going to be right around that 37, 38% no matter what. So a lot of people think, oh, the C-Corp's the panacea for everything that ills me, but they need the money. It's going to be the same thing as if you paid it out to yourself, pretty much no matter how you get it out. The trick is when you don't need that money, you can park it in there and let it use it.
Right.
And that's called income splitting. Anyway, but that's to pay yourself out of a business. When I say W-2, that means running it through payroll. You cannot run payroll through the partner or the sole proprietorship. That you cannot pay yourself a salary when you are. It's 3.8. See, Bob's helping me out. See, yay, Toby gets one right. Assuming he's right, we could both be right.
No, that is right.
All
I'll tell you later how we calculate that.
right. No, you're going to make my head spin, aren't you? All right. So partner and sole proprietor, you cannot pay yourself a salary. S-Corp and a C-Corp, you can. Why an S-Corp is so much more powerful than a sole proprietorship is because you only pay the old age, death, and survivors or the Social Security tax on the W-2 wages. You don't pay it on the distribution. So like whenever you hear somebody say, my S-Corporation saved me $10,000 last year, the reason that they're saying that isn't because the S-Corp is some magical tax rate. And yeah, it could be an LLC tax as an S-Corp too. Remember, LLCs is not a tax category. LLCs, you have to pick one of these of how to treat it. It's going to be either a partnership, sole proprietor, S-Corp, or C-Corp, or disregarded rather than a sole proprietor. Just you ignore it. But if you're an S-Corp, then you get all this extra money, and it's not subject to old age, death, and survivors and Medicare. All right. Let's go to the next one. You guys are asking a lot of good questions, by the way. I'm going to try not to completely. If I use my savings as a loan to C-Corp to start, how do I get my startup costs back, and is that taxable? So first off, it's if you give the money to your corporation, that's paid in capital.
Right.
Then the corporation would write off its expenses, and that's not income to the corporation. So it would have a carry forward loss. If you loan the money to the corporation and has startup expenses and wants to pay you back, it writes off the expenses, but then when it has income, it just hands it to you as repayment of that loan. You don't have to pay tax on that. If it's more than $10,000 of a loan, then we have to make sure that we're charging a reasonable rate of interest on that loan to your corporation. Reasonable rate is federal AFR rates, which are right around 3%, right between, I just did this. Last year it was less than 2%. Now it's just under 3%. If you stick a 3% percentage on there, you're good. And someone says, does a C-Corp give you the same break as S-Corp on payroll? Kind of. The difference on a C-Corp is it's when it's paying you out profit, it has to pay tax on it first, and then you pay tax at your long-term capital gains rate. So again, it's all a matter of it depends. And the 3 rules, because if you've ever been to a TaxWise, you've heard me say this. There's 3 rules in taxation or anything financial. They're real simple to remember. The first one is calculate. Second one is calculate. And the third rule, a little different, is calculate. All right, they're all the same. It's you always calculate it because nobody knows, not unless you actually get your pencil out.
Yeah, so when you're paying a salary out of your C corporation, you're lowering the corporation's taxable income, but you're increasing your personal income.
Yes.
So that's why you have to calculate.
Yeah, you're a bucket, it's a bucket. And if you have all of the water in you, you get this huge tax hit. Whereas if it has all the water in it, you're a dry bucket and you hate life. But if it puts half the water in you and half the water in it, it's amazing at how much less tax you pay. It usually shaves your tax bill by about 15%. And there's a bunch of other beautiful things you can do. Can your C-Corp be taxed as an S-Corp? And yes, you can make, but it's an election that you make. And then if you go back, you have a 5-year waiting period to do it again. So somebody asked what they could do that annually. Stop that.